Welcome to the Risk Reversal Podcast. I'm Nathan, joined by Guy Adami. Guy, good morning.
Good morning to you. It is a Monday. It is July 21st. It is also your daughter, Alex, your oldest daughter. It's her birthday today, so happy birthday to Alex Nathan.
You are the man. You are always Johnny on the spot with the birthdays. And I know, I can't imagine that you actually have a calendar somewhere other than in your brain. Yeah, look, there it is, up there in your brain. You are 95% of the time on with people's birthdays, random people too, like you have met, here, there, everywhere, that sort of thing. So thank you for reminding me it's Alex's birthday. I have to go get her something here. Guy, we got a lot to do. There's a lot of earnings. There's some data this week. We're still digesting a little bit of the bank earnings last week and what that meant. There's also, it's interesting where the market is, some of the sentiment stuff that you and I are hearing, even I'd say anecdotally, some of the things. So we'll talk a little bit about that. But first things first, you and I are in a business. I think you were a little over 30 years in this fine business of markets and trading and now commentary and everything like that. Would you say it's fair that we take a lot of risks? Some are calculated, some are just coming straight from the gut, right?
Yeah. No, well, it's amazing how quickly time goes by, but 39 years actually. What? So in May of next year, it'll be 40 years. I started in 1986.
Wow.
So to answer your question, yeah, I think the nature of our business has always been to take risk in one way, shape, or form, and whether it's trading things or whether it's betting on yourself. And I think a lot of people do similar, but I think in our business, it's sort of first and foremost.
All right. So, we've gotten pretty good at it, or at least dealing with, let's say, the after effects of the risk taking, right? And so that's one of the things that you better get good at it if you want a long career in this business. So last night, I'm in Bangor, Maine. I'm in the airport, okay? So where we go in the summer, our in-laws and our family up there, it's about an hour and a half away from the Bangor airport. We have a guy, picks us up. We go to the airport. We're sitting there. It's supposed to leave at 6:20. They push it to 7:20, and I know they're going to keep pushing it. There's an air stop in Newark and all that. So at that point, it's 6 o'clock. I make what I think is a good calculated bet that we should go rent a car at the Avis and we should drive the 6.5 hours. Now we've just gone an hour and a half. And then the whole time I'm saying to Sarah in the car, it's driving rain, we're going south, that sort of thing. I'm like, did they cancel the flight? Did they cancel the flight? Did they cancel the flight?
You were hoping they did.
I was hoping.
Justify your decision.
Correct. So it ended up going off at 8:30, landing at like 9:45. I would have been home in the city by like 10:45, that sort of thing. You know what time we got home?
Probably about 1 o'clock.
We got home at like 12:30. Now, I chose not well there. You know what I mean?
You chose poorly.
Yes.
But, that's only with the ability to sort of have revisionist history, with the benefit of looking back. But you had to make a decision in the here and now. And I'm glad you bring that up because, with the markets, everybody has sort of the benefit of hindsight and everybody's a genius after the fact. But we're trying to get ahead of things and try to think about and talk about things as we see them transpiring, not sort of in the rearview mirror. And at times that makes you feel potentially sort of silly or foolish.
Mm-hmm, no doubt. And, just looking ahead a little bit, I think CC has this in our newsletter that came out last night. I think the S&P is implying a 1.1% move in either direction this week, 1.4% for the NASDAQ in either direction. I find that fascinating. We've just kind of entered this very low vol sort of environment, which is one of the things like, okay, we're going to hit some of the earnings. We'll hit some of the data here. But, some of the things that stuck out to me over the weekend, Guy, were, basically talking about momentum waning a little bit. There was an article, I think, in the Wall Street Journal. We'll hit that. There's also something really interesting from the Prof G, Professor Galloway. He has a couple really good podcasts.
He works with the Kara Swisher.
Yeah, so he has the podcast Pivot with Kara Swisher. He's got Prof G Markets, and he's got what I think is we'll put it in the show notes, a really good, he works with a guy named Ed Elson, I think. They have a newsletter here, and it was talking about volumes in the market. I want to just throw some of this data at you, and I want to kind of get a sense for you, what you think about this. So Q2 was the biggest trading quarter in history. In the first half of the year, retail investors bought more stocks and ETFs on a net basis than any other 6-month period in the last 10 years. Together, The 5 largest U.S. banks, they're talking about just volumes there. They pulled in over $34 billion in trading revenue. That was up 17% year over year. Retail order flow reached a record 36% of the market by late April, up from under 10% in the pre-pandemic. Nearly 1/3 of investors ages 18 to 24 bought a meme stock. And lastly, this stuck out to me, Guy. Since early April, the 858 unprofitable stocks in the Russell 3000 have returned an average of 36%, outperforming their profitable peers. Okay, retail's driving the train. Volumes are up. They're getting more risky. They don't care about profitability. They're buying meme stocks. We could probably throw some crypto stuff in there. What does that tell you?
What does that sound like to you? And if you go back in history and read about market tops or market bottoms, what you're describing is classically some of the ingredients for exactly that, a market top. And I think one of the reasons people feel bulletproof now, and to the extent that they lived through April, and I'm saying that in sort of air quotes because there was not really a lot to have to endure. It was a 3, 4, 5-day event. People saying to themselves, you know what, even if this market sells off, it's just going to sort of provide me with this opportunity to get in again because the market doesn't want to go down, does not go down. And, I think people become desensitized to a lot of things, and complacency in terms of the market, at least, is probably an all-time high. And you're seeing it with a number of different asset classes. And it doesn't mean the things that have been concerning have gone away. As I've said a number of times, all the things that I've been worried about are still manifesting themselves in some ways, maybe worse than ever. Some of these metrics that we look at are absolutely flashing red. But the flip side of that coin is the power of investing, the power of passive investing, and just the power of money flows. And that's seemingly overwhelming the technicals and the fundamentals right now. Now, I don't know how long that's potentially going to last for, because as oversold as we were in the first 2 weeks of April, that's how overbought we are now. But nobody brings that up. Everybody's fast to bring it up on the downside when things are overdone, but people want not to recognize it or not to acknowledge it on the upside when things are overdone. And I think that's where we are right now.
Yeah, no doubt. And, a lot of good stuff. I had Dan Niles of Niles Investment Management on the pod Friday morning, and we talk about some of this stuff. We talk a little bit about history and, what was driving the train 25 years ago, what was driving the train into the financial crisis. We talked a bit about his process and some of the areas in which he's focused, and then some of the areas in which he wants to be a bit more cautious is in the Q4 or so. So check that out. It was in the feed on Friday. But here's the article. It was actually in Bloomberg, Guy, that I just mentioned. S&P 500 signals the U.S. stock market rally momentum is waning. Okay, so it kind of ties in a little bit of what you're saying. The S&P 500 index has gone 17 sessions without a move of 1% in either direction, the longest stretch of relative tranquility since December. And there's a lot of stuff. Here's a quote from our good man Dan Greenhouse of Solus that was in the article. He points out that the share of S&P 500 members above their 200 or their 20 and their 50-day moving averages has declined lately, an indication that the rally may be losing energy. So we talked about on the week, Guy, a week that we're going to have a lot of big earnings, right? That and a lot of commentary in and around Fed Chair Powell. We know that's been something going. The fact that the S&P 500 options are only implying about a 1% move in either direction, it seems complacent.
I believe so. And you mentioned Jerome Powell, so let's get to that, and not to bury the lead, but obviously he's been top of mind for a lot of people over the last couple of weeks. And what I have said, and again, what I believe to be the case, I think President Trump, then candidate Trump, was very upset at the Federal Reserve in September of last year when they lowered rates. I think he felt, and I think a lot of people felt, that was a political move. I am not one of those people, by the way, but I do think there was some thoughts around that without question. I think his anger only sort of grew as other countries lowered their rates. It obviously sort of culminated in early April when there was really talk about firing Jerome Powell. I think the bond market absolutely scared the president and the administration, and they sort of backed off on some of the rhetoric. But I think the anger never subsided, and I think it's been brewing. And again, as countries have been lowering rates, I think that's just sort of overflowing now. And I think the anger, which has been there for the better part of probably 8 or 9 months, is sort of at a peak right now. And I do think there's going to be a continued push to sort of browbeat him out. And I read over the weekend, I'm sure you did as well, that there are some people that think during his testimony or speech tomorrow, I'm not exactly sure what Jerome Powell is doing, but there's talk that maybe he will step down. Again, I'm hard pressed to believe that'll be the case, but if you put yourself in his shoes, he's obviously getting up there in age. Do you need the aggravation, I guess, is what it comes down to, or do you push back and fight for your legacy? And I think that's sort of where we are right now. But I think your point is the market doesn't seem to care about any of that.
Yeah, and I think your last point is really important. I think here's a guy who served our nation very proudly. Here's a guy, I think, who believes in the sanctity or, just the kind of separation between the Fed and, political sort of the infrastructure there and the independence of it. I just don't see him backing down whatsoever. I think that he's already taken a lot of the brunt, you know what I mean? And so at the end of the day, this is the last sort of pillar of this sort of market, in my opinion, because it's done okay with trade. It's done okay with tariffs. It's done okay with geopolitics. You know what I mean? Like, here we are. The S&P's at 6,300, and a lot of strategists are getting emboldened. I just saw, somebody say, all right, well, we're kind of leaning more towards the bull case, which gets us up 7,200. I mean, think about that, right? A 12-month target or something like that. So again, as we get into Q2 earnings and get Q3 guidance and get more clarity from the Fed on that July 30th meeting, if we don't see commensurate, rises in S&P 500 earnings numbers and these strategists are just kind of playing the momentum, like that's also going to be a problem from a sentiment standpoint. Like, you're going to have to show us the numbers, which brings me to kind of Q2 earnings. The banks last week, and you were on Fast Money all week. I was there towards the end of the week. There was not a lot to kind of poke at in those numbers. There was not a lot to poke at as far as the sentiment as it relates to the consumer, especially out of the money centers. And so I'm just curious, as you reflect on all of that last week, okay, were there any, forget like, valuations, JP Morgan, we on the way in, we said it, you were saying 3 times tangible book, Jamie Dimon's not buying his stock, but it was more about the commentary about the U.S. consumer and the state in which they are in at a time where there should be lots of headwinds to the markets, to the economy, that sort of thing.
Yeah, it was. Yeah, I agree with you. I think the commentary, it's hard to sort of poke any holes in some of the commentary. Now, as you know, a lot of these bankers tend to look at things through rose-colored glasses, Jamie Dimon not being one of those. But, if you just sort of look past valuation and things you talked about in terms of the commentary, in terms of the numbers, there was not a lot to quibble with. But with that said, when you start to sort of go beneath the surface and look at, and we talk about this all the time, delinquency rates on a number of different things, whether it's mortgages, whether it's autos, whether it's school loans. I mean, they're all starting to tick higher. Now, the optimist will say, yes, they're ticking higher, but they're still at, historically low levels. The pessimist will say the rate in which they're changing is alarming, and we haven't seen that rate of change in, 10 or 15 years. So there's something for everybody. Right now, it's 63.15 or so, an all-time high in the S&P. The market obviously cares about none of that. And, maybe that's just the paradigm shift that we're in right now. Maybe historical valuations are sort of thrown out the window, especially in an era where passive flows dominate everything. I don't believe that to be the case, but right now it's hard to argue against that.
All right, so here's another thing. I want to get your take on this. There was a lot of commentary about Fed Governor Waller, right? And he's saying he thinks that they should be cutting at this meeting 25 basis points. He might actually dissent. There hasn't been a dissent, I don't think, in a while. But part of it, he's focused on the employment situation here, which brings us back to last September when the Fed started cutting interest rates, right? So what I don't get is if part of this rally in the market is because everything's cool, because tariffs are not going to be the headwind that a lot of folks thought, because trade deal is going to get, or the tariff tax deal is going to give us, a tailwind, right? Some of the spending is going to kick in on this thing, which is going to buoy consumers. Corporate tax cuts are going to be great for investment and R&D and CapEx and all that sort of stuff. Then why is the one guy on the Fed who's willing to dissent, worried about things, if he's also interviewing for, let's call it the Fed chair position, whether Fed chair Powell is fired or steps down, or they wait until announce him, 6 months earlier, whatever, that doesn't seem to line up, at all. I don't know.
Yeah, I agree with you, and I hope, although listen, I've been around long enough, I hope it's not one of these open audition things, which is why you hear some of the commentary. It happens a lot in sports, and I know you're familiar with this, when teams are doing poorly, and let's say there's an ex-coach in the booths for one of these sports, and they start to sort of hint that that's a job that they might be interested in, and they're obviously talking to an audience typically of 2 or 3 people, and that 2 or 3 people is typically management and ownership, looking to sort of insert themselves into the conversation. So, maybe some of the commentary around Waller is exactly that. I hope that's not the case, but people are people, I guess, at the end of the day. But your point is well taken. You can't sort of have it both ways, I don't think. But right now, I do believe there are people that sort of want to have it both ways. You mentioned the job market. There's a resiliency to it in terms of the numbers. But again, like many things, when you start to dissect it and look below the surface, I mean, there are things that should be concerning. And I am shocked that the unemployment rate is still where it is. I'm definitely one of the people that thought we'd be markedly higher by this time this year. We're not. But again, it doesn't mean it's not going to happen. And, it's just a question of if, in fact, the job market starts to deteriorate, is that going to be counterintuitively a positive thing for the market, or is it going to be sort of bad news is bad news for the first time in a while?
Yeah, so thinking about Q2 results and Q3 guidance, when guidance was given for Q2, it was late April, it was early May, things were kind of mayhem. Managements were obviously a bit cautious, but then we started to get some of the data out there and it started looking pretty good. So you had a pull forward, you had 40% of S&P earnings come from overseas. So you had a US dollar that had averaged 107, the Dixie, in Q1. I think it averaged about 100 in Q2. Here it is at 98. So you have all these sorts of things. You had really poor sentiment. You had numbers coming down. You had a pull forward. You had the U.S. dollar lower. I'm probably missing a couple things there. Q2 earnings are going to be good. Like let's just call it what it is. And then Q3, a lot of folks, a lot of economists, a lot of strategists are saying that the give back is going to be late Q3 into Q4 if we do have higher tariff rates. But if you're shorting the market based on what you think corporate earnings are going to do, or margin pressures and this and that, whatever, based on pass-throughs and this and that, whatever, that's a tough reason to do so right now, because we're not seeing a lot of deterioration in the employment picture. We're not seeing a lot of deterioration in the consumer. We are seeing probably what equates to a wealth effect with the stock market up as much as it is. We just gave you that retail data, the investors. If you bought the dip, you're feeling pretty good about a lot of things. You bought crypto down there. You bought meme stocks. You bought, unprofitable, stocks. And, so all of that makes, for this, environment where people, like to your point, they're just not feeling the risk here, man, or the potential risk.
Nor should they, quite frankly, because each time, we said it earlier in the show, but for every sell-off in the market, and, it seems as though duration seems to be less and less in terms of how long they last, people feel more and more bulletproof. And maybe they're right to feel that way. Maybe people like me sort of are a dying breed, trying to point out all the things that can go wrong and send up sort of some of those warning flares. And, maybe they're exactly that. They're just a flare and there's really nothing to be concerned about. But you don't want to be the boy that cried wolf, clearly. But at some point, you need to be that person, because you need to point out some of the things that can go wrong. And I think people forget how quickly things can turn, especially when it comes to the market. And it typically comes out of nowhere, something that nobody really sort of thought about or discussed. And, those events typically lead to some of these moves. And, you see how quickly, markets grind higher typically. Markets don't grind lower historically. Markets take pretty dramatic moves to the downside. And as much as people will say today that they can't wait for that type of move because it's what they've been waiting for and longing for, when it happens, it's typically a lot scarier for reasons they never envisioned. So, with each passing day, with each move higher in the S&P, with each turn on the valuation metric, I just personally things get sort of dicier and dicier.
Yeah, escalator up, elevator down guy is what you're talking about. Here's one thing you just mentioned. You don't always, and I know the proverbial you, to be the boy that cried wolf. I think a lot of our listeners, a lot of our viewers, they get it. Like just like any trade, just like any view you have in the market, you better know the other side of it, right? Like how that can go wrong. And again, that's something, it's not like we enjoy doing it because it's like, intellectually stimulating, but, someone's got to do it. And, I just read this, there's the other side of kind of calling out what could go wrong is like some of the folks you never hear negative. Now that's fine too, right? Because a lot of folks, they want to hear what the bullish case says. They want to feel good about their positioning. Most investors are always long, right? So this was in Jim Cramer's morning top 10, and it's a great newsletter. I mean, Jim really focuses on 10 things that he thinks are, going to be impactful in the markets today. But this kind of stuck out to me, guy. President Trump's big, beautiful bill is about to unleash a giant amount of spending. Don't give up on retail. It contains so many provisions that will boost the economy that we will need to rethink the possibility of a hobbled consumer. And I just think that's interesting, okay? Like, that right here at 6,300, I think there are very few folks that in early May we're saying that, right? Because, and you could say there wasn't a lot of clarity because we know the taco trade is always going to chicken out. But guy, the higher the stock market goes, the higher it goes relative to the February 19 highs. Why wouldn't this administration? They're not seeing a lot of folks running to them, the EU, Mexico, Canada, a handful of other allies. They're not running to them, or China. China's going to get to that 90-day point to do deals. Now, wouldn't this be the time to flex again? You know what I mean? And again, I don't know if they do hold firm on a lot of these things, and we have the EU with reciprocals. When you see headlines that the EU is trying to negotiate a deal, but they are getting reciprocal tariffs in place, that doesn't lead you to be so optimistic.
Now, you're talking about flexing, and you're talking about flexing from the United States, and you're talking about the ability to flex because the stock market's at an all-time high. And the one thing I think that is an overriding concern for the administration, and rightly so, is the health and the sanctity of the bond market, which obviously showed cracks in April, and to a certain extent, but not to a equal extent, what's going on in the stock market. But, when you've collected all these chips, and again, I'm sort of air quoting the thing, in the form of an S&P that's an all-time high, you can play a little fast and loose in terms of some of the rhetoric and some of the harsher tones and sort of pushing back. And, I do think that's a hand that's going to be played at some point, because I'm absolutely convinced this administration knows exactly where the stock market is and exactly what's going on with the bond market. And I think, to the term you used, I think they are absolutely in a position to flex in terms of ratcheting up the rhetoric. Now, I think what they've also learned is in flexing, the market might have a 1 or 2 day event to the downside, but it doesn't seem to really care all that much. It's somewhat impervious to that as well, and maybe to their detriment, because when their counterparts see this, they see exactly maybe what the market is seeing, that it's all bark and no bite.
Yeah, and this is something that you probably did not see. This is a really important story, I think. I think it dropped last night or early this morning on the information, and I really want to get your take on this. So Nvidia had a big week last week, right? So the Trump administration, they reversed this export ban on these H20 chips that are going to China, right? And it seems like something that Jensen Huang, the CEO of Nvidia, has been lobbying for a while. So he gets what he wants. The stock gaps up. This was one of those days last week. I can't remember which day. It was closed up 4.5%. So here the stock is at 173. I think it traded as low in April as 100. Oh yeah, 86.82. Okay, so we're up well over 100%, not well over, but over 100%. So here's the information article, guy, and this is something that I think should come as a big surprise. Nvidia's China restart faces production obstacles. The AI chip giant has told customers it is only in limited stocks of its H20 chips, the most powerful AI chip. So right now, Nvidia doesn't plan to restart production. Nvidia's stance underscores the business complications stemming from the Trump administration's policy flip-flops on international trade, particularly when companies are dealing with severe supply chain constraints. This is the most important part. Reversing those moves won't be easy. TSMC's facilities are running at full capacity, and the company has shifted its production lines used for the H20. That's really interesting, right? So if there's one guy on the face of the earth who knows TSMC's capabilities, it's Jensen Huang. He has 90% of the high-end GPUs, right? And TSMC makes 90% of them. So think about that. If that's the most important thing going on, let's call it in the entire economy globally, and you might agree with that, it's more important than the oil market, this or whatever, and they can't restart because of the flip-flopping, that could find its way into so many other different industries.
Right, fair. I mean, great points, without question. But, the flip side of that coin is what the market is saying is, they're maybe even breathing a sigh of relief because they're saying, you know what, this is not a demand thing at all. This is the supply constraint thing. And, we're just thrilled that people still have the appetite for these chips. So we'll look past this because theoretically, they will figure it out. Now, what you will say in response to that is, yeah, they might figure it out, but it takes a lot longer than people think. But we're in a market right now that, they will look at this and say, this is actually a net positive, not a net negative. Now, you could see how those arguments can be made. But to your other point, it does have trickle down effects to sort of end users as well. And, maybe those stocks on the margins will be affected by it, but the ones that matter, Taiwan Semi and Nvidia and some of these other, Microsoft to a certain extent, I mean, the market is saying, you know what, we're okay with supply constraints. We wouldn't be great with demand problems, but we're fine on the supply side.
Yeah, in the Wall Street Journal, I heard on the street, they're talking about this too this morning, what chip stock investors are missing about tariffs. And I think what I take away from this, they're talking about if a chip is made in Arizona, and we know that, there's, fabs that are being made out there, it could be sent to China or Malaysia to be tested, packaged into the final form. We just don't have these capabilities built here. And I thought this was really interesting. If a part of the trade war is to basically bring back manufacturing here, less reliance, right, on the supply chains. The article suggests even if the recent growth of U.S. chip making, only 14% of the world's chips are expected to be made in the U.S. by 2032, compared to about 10% as of 2022. So again, a lot of folks on both sides of the aisle, they think about reorienting global trade for a lot of important reasons. We do want this stuff made here, but it's going to be very inflationary over a longer period of time. Maybe that Fed's 2% target should be out the window. Maybe it should be 3.2%, for the next 10 years or so. So again, I don't think it's doing the thing, or it will do the thing in the next 10 years. And I don't believe that this administration is looking out 10, 20 years about how to do this. I think they're looking to kind of use, a sledgehammer to get through some of the policies that they think are important in the here and now.
Yeah, real quick, I'm glad you brought that up. There was a window of time where the Federal Reserve could have sort of backed off that firm stance about 2% and sort of open-ended it a little bit. And I think the market is cutting them slack clear because we're all-time high. But I guess my point is they sort of pigeonholed themselves. There was a window of opportunity where they could have extracted themselves from that corner, and they chose not to do it. Now, seemingly they're locked in. They could have easily said in today's world, 2.5% to 3% is far more reasonable than the 2% we talked about a couple of years ago. And I think they would have gotten a pass. But having not done that, now they're sort of, again, firmly ingrained in this 2% thing. But, that might just be sort of, I don't know, nitpicking on my point. But I'm glad you brought that up.
All right, let's do a lightning round on earnings in the last few minutes here, because I do think there's some that are going to have, at least from a sentiment standpoint or a commentary standpoint, really interesting. I think you and I would both agree that expectations are low for a lot of these companies for the reasons we gave before, just, a whole host of just really, I guess you call it lukewarm Q2 guidance when it was given just a few months ago. All right, let's do this. Tuesday, let's go through GM and Coke really quickly, because on the consumer front, I mean, staples maybe not that interesting, but what GM has to say about supply chains and demand and pull forward, I think is going to be really interesting. Heading into the tariffs, you thought GM was going to actually be able, on a relative basis, to hang in there, and yet a couple good reasons. What do you expect to hear from GM now, and do you think it's as important as it was a few months ago?
Yeah, I don't know if earnings is necessarily this, although it should be. With GM, it doesn't seem to be. It's about deliveries. It's about, what they're writing down, what their vision is. And I do think in the form of Mary Barra, they have the right person in place. And, if you look, and I've said this, and I believe it to be the case, I think the administration, in terms of the tariffs, is laser focused on the impact it has on, the three automakers, but probably more importantly, both Ford and GM and Stellantis to a certain extent. But every time the stock seemingly gets into the low 40s, the administration pivots in some way that gives it a little bit of a, I don't know, I guess, what is the word I'm looking for? Tailwind to sort of get the stock back up. And I think that's what we're seeing now. With that said, as we get closer to $55, that's been a level of resistance. So, I think regardless of what they say, 55 to me is sort of a top. Quickly, in terms of Coke, it's Coke and Pepsi, but Coke is winning the war in terms of the stock, and I think they will continue to do that. We saw headlines last week that, the administration wants Coca-Cola to change their formula to use cane sugar out of the United States. I don't know if that moves the needle for the stock, but, this is one I think that's sort of slow and steady wins the race.
All right, here's one Tuesday afternoon, Texas Instruments, and I know this is one that you've commented on in the past. I mean, it's always got this very rich valuation. I have no idea why it trades 39 times this year's earnings, 33 times next. This is one that is not attached to the AI trade. One of the things that sticks out to me is obviously their exposure to industrial, but also consumer electronics, right? And when you think about the pull forward, industrial and consumer electronics are probably two big areas, right, in which they had that. You better have, as it relates to consumer electronics, a big pickup again, because again, after the pull forward, as you go into the holiday selling season. I think a lot of retailers do 35% of their business then. Is Texas Instrument a decent bellwether ex AI?
Yeah, in terms of industrial, I think it is without question. But it's also, I'm glad you brought it up. The valuation is ridiculous. It's been ridiculous. And, people forget how quickly, I mean, this was basically a $220 stock around Thanksgiving of last year. It proceeded to trade almost in a straight line down to about $1.40. By the way, 140 was the absolute low that we saw in October of 2023, basically a year before. I mention that because I think we actually talked about it on this show in Fast Money, the ability to sort of trade against that double bottom. That's come to fruition. Now, the flip side is at these current levels, we're potentially making a double top. So as down in the dumps as everybody was a couple months ago, I think that's how excited people are now. And although it potentially could be a read-through for the industrial side of the economy, this is a stock that I look at and say, man, oh man, you may want to fade whatever move to the upside you get post earnings.
All right, here's another name that I'd be inclined to fade into earnings on the way out. This is on Wednesday. This is a name that you've been bullish on for a while. That's been correct over the last 2 years. It's gone basically from $100 to near $300. It's IBM. The implied move in the options market is 6.5%. This is not a stock that ever traded with that sort of implied move, but on current 2025 earnings, it's expected that are only expected to grow 6%. It's trading at 26.5 times. It's trading at 24.5 times next year, expected to grow 7%. And you could say, well, it's a pickup AI that, they have a lot of capabilities on implementation and consulting, and the cloud business is growing, that sort of thing. But mid-single digits earnings and sales growth, trading where it is, and sentiment is positive as it is, at least from an investor standpoint. This doesn't make a lot of sense, Guy, into the print for me, despite the fact, and this is actually shocking, there are only 22 analysts who cover this stock on the street, 9 buys, 9 holds, 4 sells. When you think of the Mag 7, I think on average, there's probably at least 2x that analyst covering it. So interesting from an analyst perspective, not a lot cover it, and the sentiment is pretty lukewarm.
All right, so let's go back in time real quick, and then we'll get out of here. Go back to March of last year. The stock went from 195 basically down to about 165 in a straight line, subsequently bounced. October of last year, 235 down to about 200 in a straight line, bounced. February of this year, 260-ish down to about 225 bounced. And I think I bring that up because although the stock is within a sort of an earshot of an all-time high, we have seen very dramatic downdrafts at least 3 or 4 times over the last year. And I think that's exactly what we're setting up for now.
All right, 2 names, Google, really quickly. Flat on the year, guy. Expectations relative to a lot of these Mag 7 or Gen AI names, not particularly high, but the stock's starting to work back towards those prior highs. I think in late January when they reported, the stock was trading, ready for this, 207. It had a huge gap lower, went from 207 down to like 142 in the lows in April. So it still trades, like they don't have things figured out. It still trades like, some of the remedies that the DOJ and the FTC are going to have against this company, because of the monopoly case and everything like that, are overhang here. I want to be more constructive on this name, not just because I think they'll get their act together as it relates to AI across all their suites and services, but I also think the valuation is one of those ones that if you're concerned about folks getting over their skis, let's say in a Meta that used to have a valuation case, doesn't anymore, and some of the other names, the stock trades at 19.5 times this year's earnings and about 18.5 times. If you could discount some of that other stuff, Google seems to be the way to play catch up, in my opinion, to the rest of the Mag 7.
Yep. Just valuation alone. But of course, the flip side of that coin is the potential existential risks they face with AI in their search business. For you armchair technicians out there, go back and look at where we were in July of last year, about 190, traded lower. Then we traded higher, as you just pointed out, around 207 in late January, early February, traded lower. What we're potentially setting up for, and I know you're probably looking at this as well, is little head and shoulders formation. So if we were to fail here, and there's a likelihood of that happening. Google has not been particularly buoyant post-earnings over the last couple of years. The technical formation could be somewhat scary to the downside.
All right, very last one, Intel, Friday morning. You've called this a national security play. They got a bunch of money from that CHIPS Act. I know a lot of that is meant to be kind of pulled back. Here's a stock that in late 21 was trading near $70. It traded below 20 on a couple of occasions over the last year. It's rallied a bit to 23.5. There's been some interesting rallies. Don't seem to be on too much fundamental news. I feel like a lot of folks are looking for value in the chip space. They obviously have a new CEO. Is this one just kind of like, okay, your downside, it's kind of like 19.5 or something like that, and it's too cheap and there's too much potential here? Because who knows, man? Like you and I think earlier in the year we were playing for a move using options back towards 30. That would be a gap fill going back to mid last year. I just feel like the risk reward, it's kind of 2-3 up, 1 down.
Yeah, I still think you stay with this. If we continue sort of this trajectory, people like Carter will be talking about a potential bearish to bullish reversal without question. We've sort of flatlined around that, as you said, 19.5, 20 levels since last summer. I think you try to stay with this thing, understanding you have seen significant downdrafts along the way, but I think they probably have the right person in place. If they start to say the right things, and you start to see some stabilization. This is a stock that I think can easily get back to the levels that we cascaded lower from. That was about $33 in this time last year.
Yeah, it's crazy. In 2021, they did $5.50 in earnings. They had a loss last year, expected to do 31 cents this year. I was at this tech conference last week. Pat Gelsinger, the prior CEO, was on a panel.
Push up, man.
Guy, I literally almost fell asleep every time he opened his mouth. It was actually, and he's on like some quantum computing board right now. They couldn't even get CPUs and GPUs right. And you got this guy on a quantum computing company board or something like that. So is what it is. All right, we got a lot of earnings. We got a little bit of Fed speak, some economic data, a lot of stuff expected on the trade and tariff front. We got market call Monday, Tuesday, Wednesday, Thursday. 11 a.m.
That was your Apollonia attempt, Apollonia. I know.
What do you mean attempt? They did it. I kind of like, it is what it is. We got a lot of great guests coming up on the Risk Reversal podcast. Thanks for being with us on a Monday morning. This was a lot of fun. Let's continue to take calculated risks where you don't end up having to drive 8 hours in the pouring rain and get in at 1 in the morning.